Good evening, everybody. Thank you for joining us. I'm joined this evening by Phoebe Stone, Partner and Head of Sustainable Investing at LGT Vestra. So I'd like to just extend Integrity 365's thanks for joining us this evening and for being with us tonight to talk about sustainable investing and how it can present an opportunity to work hard for you and the planet. So I'll be your host this evening. My name's Marcus Rayer. I'm an independent financial advisor with Integrity 365. We are just waiting for a few more people to join us, so I'm just going to give them the opportunity to creep in for the next few moments. Now, if you haven't joined us previously, we have held a number of webinars in the past. So this is this is actually our second sustainable investment based webinar with Phoebe, but there are others that we have done in the past. So if you haven't viewed those as yet, please do refer to our website or contact your financial advisor at Integrity 365. We'll be happy to point you in the direction of those. I will now let Phoebe take the floor. Thank you, Phoebe.
Thank you so much, Marcus, and great to have everyone on the call today. So I wanted to give a little bit of a background to the proposition that we've got and how we as an investment house think about sustainability. Because since we last spoke on Integrity 365 call, the awareness and interest in sustainability has grown a huge amount. And with an increased awareness comes an increased scrutiny, an increased level of accountability of how our proposition potentially differs to others, and really how we're thinking about and acting on sustainable values. It's really important to us as a business to be acting sustainably as well as offering sustainable portfolios to clients. Our business, that's LGT, is a global business. We are a bank, an asset manager. We're operating in 21 different locations worldwide, so very global presence. But as a business, we've been focused on sustainability for a really long time. And by really long, you can trace that all the way back to 2010, where as a business, we became carbon neutral. So that's calculating the carbon emissions produced by our operations and funding a renewable energy project to the volume of that carbon emissions. And we've been funding a renewable energy project in India for quite some time. But carbon neutrality doesn't take us to where we need to be to meet the Paris Agreement. And that's really where net zero comes in. And as a global business, we've made a net zero commitment by 2030. So that's 20 years ahead of the Paris Agreement. That's 20 years ahead of most of our peers, and a majority of our peers haven't actually set net zero commitments, but where they have, it's 20 years out. Now, then the next question comes, how are you going to achieve that? Because that's a really ambitious goal. Well, because we're a privately owned business by a family that's really thought about sustainability and particularly climate change for a number of years now, we've been able to partner with an organization called Climeworks. So Climeworks are the only company today to be able to offer carbon capture and storage. And they do that by using the machines you can see there on the slide in the bottom left. So this is one of their carbon extraction. It's basically an extractor fan for carbon. This one is in Iceland. They extract the carbon from the atmosphere and then either bury it in rock strata, or they can actually use that carbon dioxide in everything from a fizzy drink all the way through to pumping it into a greenhouse to make plants grow more fruitfully. So we've signed the biggest agreement with a financial services business globally in order to take our business to net zero. And that sort of commitment and focus really sets us apart. And I feel very proud to work for an organization that is thinking about net zero so holistically and not just putting it as a shiny gold badge on a fund or a proposition. It really is integral to our business. When we're thinking about sustainability from an investment perspective, it does look a little bit different. You may have heard this acronym ESG thrown around a lot. It's now covered a fair amount in the mainstream press. ESG is an important part of our process when we're thinking about sustainability, but it's only one part. So ESG, for those of you who aren't so familiar on the call, stands for environmental, social, and governance. And that image or graphic on the bottom of the slide there encompasses some of the factors that you need to think about when you're ESG investing. Effectively, ESG encompasses potentially hundreds of data points or information points that you can gather about an investment and a company, mostly are considered in this. So you're thinking about a company from an investment perspective, you're absolutely thinking about the company's balance sheet, the revenues, the profit margins, the expected growth. But when you're encompassing ESG as part of your investment process, you're also taking into consideration how that company interacts with the environment. So the carbon emissions produced, the pollution produced, the level of recycled waste or otherwise. From a social perspective, the health and safety of the workforce, how that company interacts with communities, how that company's products, whether they're safe or not. And then from a governance perspective, the board independence, for example, how that company's remunerating their board, the diversity of the people working within the business. So you're starting to gather these additional data points and using these additional data points or information points to value the company. Now, this is becoming more and more commonplace as investors start to realize that value is attributable to a company's stakeholders, and those stakeholders being the environment and society. And actually, by valuing a company based on how that company interacts with society or the environment, can potentially demonstrate whether that company is going to be a better run business in the future, and therefore is able to generate that higher level of capital growth. You're even seeing examples in the press where companies are lambasted for not having good social and environmental policies in place. And a recent example would be Boohoo, the fast fashion retailer. During COVID, it was unveiled that they paid their employees very, very low amounts, much lower than minimum wage, in appalling conditions. And their share price was very hit as a result of these allegations coming to light. So for investors, unless you're taking into consideration these risks, you may not be insulating your portfolio or investment process against those risks. But considering how a company is run is one part of the story. We're also wanting to make sure that there is an intentionality behind the allocation of capital. And this intentionality idea comes from the goal of wanting with a portfolio, yes, to generate strong growth in terms of investment return, but also looking to generate something more. And that something more being a sustainable future, not just for future generations, but actually for today's generation. And that sustainable future encompassing a better environmental focus and a better social outcome for today's population and certainly tomorrow's and future generations' population. And that leads me really nicely on to impact, that measurement of positive impact. And that's a really important part of our process. We look to measure and demonstrate impact within the underlying companies. And we often use case study examples of companies in the portfolios today that are clearly demonstrating positive environmental impact. So that could be renewable energy that's generated. That could be a company that's facilitating advanced recycling. It could be a company that's in the social inclusion space, or like, for example, microfinance, or indeed in education or in healthcare, for example, diagnostics or higher levels of nutrition. So there's a really broad scope of different investment opportunities that are generating impact, but also focused on return. When we're thinking about impact, one really easy framework to use when we're thinking about the allocation of impacts in a portfolio is this framework set out by the United Nations. And this was set out in 2016. These goals were effectively a set of targets, of a checklist for countries around the world for us to aim towards a peaceful and prosperous planet. These goals are used fairly frequently now by the investment community. And to our analysis, 11 of these goals are investable in the portfolios that we're able to offer you via Integrity 365 advisors such as Marcus. We bucket these 11 goals into 4 sustainable investment pillars, and a portfolio that we would run would target investment across all of these pillars. Today, there's a lot of focus around climate, pillar number 4, but really there's a spread of investment opportunities across these different pillars, but they do flux and shift over time. Now that depends on the investment opportunity, but also where we are in the market cycle. How does this translate into a portfolio? Well, the portfolios, if you're already an investor, then you'll be familiar with this, but they look and feel like a standard portfolio. We're not reinventing the wheel when it comes to managing portfolios. We're looking to build a diversified portfolio, investing in assets that you'll be very familiar with. For example, government bonds, government debt, or corporate debt, where a company goes out to market to look to borrow from the market in order to facilitate growth or development. We're also able to use specialist impact bonds. So this is where a company issues debts and says they want to borrow, let's say, £1 million, but they specify the project that the money is going to be going towards. And if it's an environmental project, for example, putting solar panels all over a roof of a building, or a social project, if it's targeting education for a certain demographic, maybe an underprivileged demographic, and you're able to measure and demonstrate the impact generated, it's called a social bond or an impact bond. It's a very pure way to get exposure to impact in the portfolios. And we have specialist third-party fund managers that are investing in those types of assets. We're also using equities. We're using global equity funds. We're using dedicated geographic exposure funds, and you'll see those in your portfolios, whether it's an Asia fund or a European fund. And we're also using dedicated impact fund managers to target some of those areas that I mentioned to you earlier, using the UN Sustainable Development Goals as a core framework. So hopefully that's a helpful bit of background to the strategies. And I really want to bring things sort of bang up to date, because the goals of these webinars is to keep you in the loop with the regulatory environment, the macroeconomic environment when it comes to sustainability. And things are moving very, very quickly. So much faster than we saw happen back when we launched these portfolios around 4 years ago now. And we've seen from governments a really consolidated effort, particularly in the run-up to COP, which of course was in autumn, in November last year. In the run-up to COP, many governments were releasing targets, releasing their strategies. We saw it from the UK government, and we've seen various different iterations of the net zero strategy, the 10-point plan, and an enormous amount of money really committed. But we would say that the UK has been a bit behind the curve in comparison to regions like Europe, or Europe as a trade bloc, as a nation or a region, over the last decade has spent by far and away the most when it comes to thinking about a holistic strategy. And the Fit for 55 is the most recent of those, where Europe's looking to specifically reduce emissions by 55%, which is more than the Paris Agreement, which is 50% by 2030. So Europe's sort of been ahead of the pack for a very long time. The UK is a bit behind, but then what's a much more recent addition to countries committing to net zero or focusing a lot of money on climate strategy are countries like India. You saw a very exciting and actually surprising commitment at COP by Modi from India to commit India to net zero by 2070. So that is, as you'll be aware, 20 years behind the Paris Agreement. But given that going into COP, Modi was very clear that he did not want to sacrifice the economic growth of India for a benefit to the environment, the fact that they've now committed to net zero is a really strong realignment of domestic politics and very, very exciting announcement. They've also committed to producing 500 gigawatts of renewable energy by 2030. Now, just for context, that's the total solar power production globally just a couple of years ago. So really meaningful investment in India from their green transition. And also you'll see their commitment by the US. Under Biden, there's been a significant shift, as you would imagine, in attitudes towards climate spending. We saw the infrastructure bill, which was passed in November, as Biden was able to do what Trump certainly wasn't, and pass over $1 trillion US of spending. A significant slug of that was towards climate, certainly trying to get the US to where they had been neglected with regards to infrastructure around climate, so electric vehicle charging and renewable energy spend, and even green hydrogen spending, get them to where they should be today. And we have all eyes on a potential future climate bill that we're hoping is going to be passed before the midterms, which looks to take the US towards the future and looks in part to take the US towards their net zero commitments that they've now made. So the US is certainly part of the pack. And I think one of the reasons that the US has been so focused on their climate investment in recent years under Biden is because they have really clearly seen how much further ahead countries like China are. So we've been getting a lot of questions on our focus on China or our investment in China as a result really of the Ukraine-Russia situation and this idea of how do you deal with an autocratic government when you're thinking about ESG investing. I'll move on to talk about Ukraine and Russia and the invasion in the next few slides, but I thought first off it was important to talk about our approach to China. So China is a difficult conundrum really, because as a country, they're the biggest investor in renewable energy, the biggest producer of renewable energy, and the biggest consumer of renewable energy globally. They are very much the leaders when it comes to climate innovation and climate technology. However, the obvious point is as a country, they are responsible for a huge number of human rights abuses, and it's difficult to think about China with a very rosy ESG lens. So our approach is not to invest in the Chinese government debt, so we wouldn't be lending the Chinese government money, but we would selectively, and we do selectively invest in companies in China. We make sure we do so using very specialist third-party fund managers that have national Chinese speakers, Mandarin speakers in China, visiting the companies, visiting the headquarters, visiting the plants to make sure those really high sustainable credentials are met and tapping into that really fast growing part of the market. So taking that very, very qualitative and quantitative hands-on approach to research. And that's absolutely what we would expect when we're using a third-party manager to access that part of the world. There is a really fast-moving regulatory environment going on. It's not just, oh, the lights have gone off, hopefully you can still see me. It's not just an evolving government attitude. There's regulation across the world and various different spheres really pushing on the agenda behind sustainability. Just to give you a sort of a bit of a snapshot to what that looks like, and a lot of this has evolved a huge amount since we last spoke. Just last week, you had the announcement that the US regulator is planning on enforcing effectively a law that companies that are listed in the US have to publish their scope 1 and 2, which is their operations, and their scope 3 carbon emissions. So this is effectively bringing the US in line with other places of the world like the UK and Europe, where companies are encouraged or at a certain size of company or employee number, you have to publish net zero commitments, you have to publish your scope 1, 2, and 3 disclosures. And that will obviously mean that investors pay more and more attention to those as not necessarily at the moral angle of investing in a company because of its carbon emissions, but absolutely the financial angle and embedding that cost of carbon within your financial analysis. Now that's coming fast down the track. It's already happening in many other parts of the world, and the US is playing a bit of catch up with regards to that. What that'll mean is more and more sustainable investing and this ESG analysis I started talking about just becomes mainstream. And all financial analysts will embed that in their cost of their valuation of a business going forward. There's also specific regulation coming down the track for Marcus and I as individuals working in the asset management and financial management industry. There's a set of disclosures that are required for European companies called SFDR, and it's all about disclosure. It's trying to reduce the issues around greenwashing, where potentially a company or an investment portfolio is marketed as sustainable, but actually if you look underneath the bonnet, it's nothing more than a nice glossy brochure. This regulation looks to try and stop that, and it does so through various sets of disclosures. Because we voted Brexit, we've come out of the European Union, we are not required to report under that regulation, but the UK is bringing in their own version, and we're likely to see some form of that over the course of this year. So that will mean that financial advisors like Marcus are required to ask more questions about you as a client and your sustainability preferences. and really assess what you want to achieve with your portfolio other than just financial return. And this idea around backing companies that are looking to generate a more sustainable future for us all will be part of that discussion. There's other regulation going on at the moment, which is looking to align global accounting standards. So at the moment, there's a few different bodies which are trying to align accounting standards that exist and have existed for a very long time, but certain sets of ESG accounting standards. And I think once there's a decision made on the direction of travel of which way we're going to go, and there's a lot at COP around all of this, it will mean that investment managers, auditors will all be singing off the same hymn sheet when it comes to analysing a company from an ESG perspective. And for me, this is a major, major shift, because it means that if you're not a company that's not aware of some of these evolving dynamics, whether it's environmental dynamics or social dynamics, and you're effectively being marked down on this accounting framework, that company is a vulnerable company. And so as an investment manager, if you're not aware of these dynamics going on, you may be stuck in these companies that effectively aren't prepared for the future, don't have those good social credibility metrics built in, or aren't addressing environmental issues like pollution or plastics or carbon. So this, when it gets decided, I think will be a real watershed moment, and the ESG integration that's already going on across our industry will just ramp up and up and up. And that really means that you want to be investing or using fund managers or managers that are aware of these dynamics and how they'll play out. Climate remains a really core focus. We're having increasing numbers of conversations with clients and with companies about other aspects like biodiversity, but biodiversity links directly back to climate. If we think about the companies that are committed to net zero, that sits at around 3,000 and counting. For companies, obviously, in the emerging markets, it's much more difficult for them to set net zero commitments. In the West, we've effectively outsourced carbon emissions to other countries that are making the goods and service, or making goods for us that have a lot of high levels of embedded carbon. And also they don't necessarily have the resources or the expertise pretty much the money available to be dedicating teams of people. So as investors, we have a responsibility to help companies based in emerging markets develop those net zero commitments. Last year, at the end of last year, we saw the UK issue the first green gilt. So I mentioned green bonds earlier on in the presentation, where a bond is issued by a country or a company to fund a specific project. This happened in the UK, where we issued bonds, quite a number of bonds, specifically around rewilding, interestingly, and solving this idea of nature-based solutions, how you can't just have technology to solve net zero crisis, the net zero crisis. You absolutely need to be protecting forests, you need to be protecting woodlands and swamps that are very high carbon extractors naturally. So it was good to see the UK government do that, but a little bit behind the curve, to be honest with you. Many other countries in Europe and actually in Asia had already issued green bonds by the time we did. I think the climate reports that you may have been aware of in the last few months have very much painted a fairly depressing picture, to be honest with you. We saw the report come out before COP26, which demonstrated that there is a now near linear relationship between man-made carbon emissions and climate change. Effectively, humans are responsible. And that really meant that the science was no longer up for debate at COP, which is extremely helpful. And then more recently, we had another pretty depressing report by the IPCC, which demonstrated that adaptability or adaptation, effectively what we need to do to cope with the changing climate and rising temperatures, that's already started, that's already happening. And in this report, it demonstrated that 50% of animals of species have actually started moving further north in order to cope with rising temperatures. So it's the first report really where adaptation is not a thing in the future that we need to worry about. It's something that's happening right now. And I think that really sort of underscores the importance of investing in this space. And we need to invest much more. There was a very recent report by McKinsey, which I've linked there on the slide, which demonstrates that we need to be investing $3.5 trillion a year more than we are today. So that's 60% more than today's level. Now that demonstrates that if you ever thought that you'd missed the investment in sustainability or in the green transition or renewable energy, absolutely not the case. There is so much more money that's needed to get us to where we need to get to. And I think the urgency will only increase as a result of us living through what climate change has already become. And interestingly, I'll come back to that slide. Interestingly, the war in Ukraine has absolutely demonstrated why this needed to be much higher up the priority list for a very different reason. Obviously, it's quite depressing and galling that it's taken a war for many nations, particularly in Europe, to start allocating significant amounts of money to the green transition. But the war has highlighted how important energy independence is, and the fact that maybe we don't want big percentages of our energy to be piped from countries like Russia and us to be completely dependent on oil or gas, either as a conduit country or as a source country. And this idea of energy security, and the fact that now there is a real focus on investing in renewable energy, not just for the medium and long term, but actually absolutely for the short term, has benefited the portfolios that we run, but I think has very much changed the picture. It's not just about energy security, it's also about food security. I'm sure you'll be aware by now that the Ukraine is known as the breadbasket of Europe. Russia also exports a very large amount of wheat. And this idea that we are really reliant on other countries, particularly countries like Russia, for food is a very, very pressing issue. Now, how do we solve that? Well, impossible to solve overnight. It's actually not as simplistic as, oh, there's a food transition plan. These are very, very complicated supply chains and very sort of nuanced issues. But one thing that we think will bring it brought into focus is solutions like vertical farming, where supermarkets today are investing in vertical farming sites near distribution centres, where you can effectively grow pretty much any vegetable in water. That water is 99% recycled back through, that it's temperature controlled, no pesticides, no chemicals used at all in the manufacture or the growing of these vegetables and fruits. The power is renewable energy, and the food has very, very minimal food miles. So it's a small part of the overall vegetable and fruit picture here in the UK across the board. But if you look at some individual herbs like basil, 30% of all of the basil that's used in every single supermarket comes from a couple of vertical farming sites. So there is definitely the capacity to start to build some of this out. And I think there'll be increased focus on that part of the market for the next few years to come. And finally, supply chain security. So what do I mean by that? Well, if we're suddenly much more concerned about the political impact of things like globalization and the rising dominance of some parts of the world, should we be shortening supply chains and making them more secure? Yes, we absolutely should, if that's a concern. You're also in the process cleaning up a supply chain, probably paying people better along the supply chain process, making them more transparent, bringing those supply chains back closer to home. Now, all of those are outcomes that you would want from a more sustainable supply chain. Obviously, the outcomes of that are maybe that there's parts of the world that lose out on jobs, and this idea of the just transition is an extremely important one. These are all very nuanced dynamics. If you're taking away from one part of the world with regards to economic growth, you need to make sure that there is a balancing act. That's the case for when you're shutting down coal or gas pipelines or oil extraction projects. You need to make sure that those are replaced elsewhere. If you're moving from standard or dirty steel to green steel, dirty cement to green cement, all of these transitions need to happen in a very thoughtful way. And as that transition happens, we need to make sure that it is fair, it is equitable, and we do think about the E, solving that E issue, and we don't cause loads of S issues, social issues at the same time. And I think using the UN SDG framework and understanding how interconnected all of these UN SDGs are, which is absolutely fundamental to our process, enables us to tackle those issues in a manner that's appropriate, but does recognise quite how complex this whole world is. But I think when it comes to sustainable investing, you are aware of the interconnected nature in a way that maybe with more standard investing, it is a bit more black and white, it is a bit more blunt. When you're just thinking about return, there are potential unintended consequences, which in sustainability, return is very, very important. But alongside that, what is the overall impact? So I think that this move towards sustainable investing and this move towards ESG analysis does help us mitigate some of the potential issues down the line.
Brilliant.
Great. That was everything from me. I'm just going to turn to the important information, legal stuff, and that's the slide deck.
Phoebe, that was really, really insightful. I mean, I've certainly learned a few more things this evening, and I'm sure our viewers will do as well. Thank you very much for that presentation. I mean, I must admit, I kind of overlooked that, you know, Vestra themselves had been carbon neutral since 2010 and have this net zero strategy target by 2030. So, you know, I think it's only fair to say that Vestra and yourself are kind of pioneering within the financial services industry, which is, you know, fantastic to see. And we need to see more companies follow suit, whether that be within the financial services industry or, you know, other sectors within, you know, the workplaces. So, you know, there's great areas for investment within that. I personally never heard of vertical farming and what those kind of things can bring. So really insightful, and, you know, just understanding where some of your investment money might go and what it's funding and how it's going to shape the future for individuals and so on. So yeah, what I'd like to do now is, we have had a few questions come through, Phoebe. So if you don't mind, I'll just introduce a bit of a Q&A session now with you, if that's okay.
Yeah.
One question that's come through is, how is it that if the FTSE 100 has been rising of late, how is it that clients' investment funds might be going down in value? I'm not sure if that's something that you can answer, but that is one question that's come through.
Yeah, so I think that sort of goes to the heart of what's been going on since the start of the year, where there has been a very strange market dynamic when the FTSE 100 hasn't done very well as an index for the last sort of 10 years. It's now in positive territory since the start of the year, whereas other portfolios and the sustainable portfolios that we run are underperforming that FTSE 100 index. And I think there's the real kind of point to the question is the fact that, why is the FTSE 100 going up and then the sustainable portfolio is suffering a little bit more? And there's a few dynamics to that. If you think about the makeup of the FTSE 100, it's very dominated by a certain type of stock. It's dominated by tobacco stocks, by oil and gas stocks, by defence stocks, by mining stocks, all of which since the start of the year, and particularly since the war in Ukraine, have been in positive territory. So the price of oil's gone up dramatically. The outlook for defence companies, so companies producing weapons, has obviously changed pretty dramatically. There's been a shift away from quality growth companies and into what are called value companies, and that would encompass sort of miners and the tobacco stocks. But we would view this as a fairly short-term shift. What we're looking for in the sustainable portfolios we run are really good quality companies with very strong financial credentials. That's a good balance sheet, companies that are generating higher and higher levels of revenue and even profit on an ongoing basis, and tapping into these fast moving trends, whether it's the green transition, whether it's healthcare, whether it's nutrition or sustainable agriculture. So yes, there's been this rotation in the short term, but first of all, the FTSE 100's underperformed pretty much every other market for the last 10 years. And second of all, do you really want to be investing in the oil and gas companies going into the future? They're in very uncertain territory. Do you want to be investing in tobacco, a market in structural decline? Defence is having its time in the sun right now for certain reasons. But really, if we come back to our fundamental thesis, investing in those good quality companies and growing them over time, we're very comfortable with our positioning. Excellent.
Okay. And so due to recent events that you mentioned earlier, obviously Russia, Ukraine, etc., are there fundamental changes you've made within your portfolios within Vestra to reflect on this at the moment?
Yeah, so clearly markets have moved fairly dramatically as a result of the invasion of Ukraine by Russia. I wouldn't say that we fundamentally changed our process. we run portfolios that are diversified. They invest on one hand in growth assets like equities, but on the other hand, invest in diversifying assets. And that could be your government debt issued by countries that have very good credit ratings. So actually, often these government debt assets go up when markets go down, and that's exactly what they're designed to do. We have other assets like gold in the portfolio, responsibly mined gold, that again tends to go up when markets hit these black swan events. But in order to manage the volatility, in order to sort of smooth the return profile, we did take some exposure out of equities, and we sold around 5% of the equity exposure. So that's the growth assets of the medium risk strategy at the start of the invasion, and put that into cash. And that's really helped us manage the volatility in markets. You're seeing enormous volatility, and whether it's in equities or bonds or even assets like nickel, the gold price, the oil price, because there's just so much uncertainty. And particularly with sanctions, we're facing really unilateral sanctions against Russia, and the knock-on impact of that is still being worked through the system. So the diversified portfolio strategy has worked well, but also moving some of that risk asset into cash has also helped manage the overall volatility.
Thank you, Phoebe. That's great. You mentioned earlier within your presentation about the introduction of some regulation to try and stop greenwashing. We had a question come through. I mean, do you think there's a point where all traditional investments will be effectively sustainable investments, or do you think greenwashing may be here to stay? How's that going to change, Phoebe?
For me, it's all about embedding sustainability risks as financial risks. And we're seeing that happen in a fairly major way with regards to one element of sustainability, and this idea of carbon dioxide, which is only one of the many greenhouse gases, but certainly is the one that's most lasting and the one that says there's the most produced of. So it makes sense that carbon footprinting and carbon dioxide is a major focus. Now, embedding the cost of it as a financial cost has taken a major leap forward with regards to the development of carbon markets. Now, what this means is that in Europe, for example, every company in every industry has a certain allocation of carbon that they're able to produce. If they go over that allocation, they have to buy more credits from the carbon market. If they become energy efficient, they can sell those credits. So it's effectively creating a market around carbon, and it's financially incentivizing businesses to become more energy efficient. In the background, the price of carbon per ton has gone up dramatically in the last year. This time last year, you were sitting at around 30 euros per ton of carbon. At the end of the year, it was almost 100. So companies increasingly having to pay more if they're deciding not to be energy efficient. So this has already started to really embed carbon as a risk, as a financial risk to a business. And so companies that aren't energy efficient are being marked down on that basis. The more that we see more sustainable elements being embedded as a financial risk, and whether it's biodiversity or maybe more social aspects, the more ESG will become mainstream. And I think there's something different between ESG becoming mainstream, which I can foresee happening really quite quickly, and everything becoming sustainable, because fundamentally there are things in the world that can never be sustainable. They're finite. They can be made in a more sustainable way, but you wouldn't want everything just to have that sustainable sticker put all over it. So I think in the meantime, while we're going through this transition, it's really important to look underneath the bonnet, and that's exactly what your role is as a sort of gatekeeper of investment managers like me. And it's really important that I look underneath the bonnet in the companies in the portfolio to make sure that they are actually delivering on what they say they're doing. So a lot of qualitative analysis, a lot of research, but actually looking to identify the companies that are saying that are doing what they say they're doing.
Excellent, thank you for that, Phoebe. So, I mean, from what I've taken from this is obviously governments are doing their bit, albeit somewhat slowly. Companies such as Vestra are pioneering, as we said, and really doing what they're trying to do for investors themselves. And hopefully more companies will do what Vestra are currently doing, and it's probably up to the individuals as well to make sure that they choose to try and invest as sustainably as possible, and how they might access that. Now, I would suggest anybody looking to invest sustainably who doesn't really know exactly what they're doing would be best placed to come and speak to their financial advisor, because obviously there's many different routes in which somebody might be able to invest sustainably, as you mentioned earlier. Yeah, I mean, wonderful presentation. Thank you, Phoebe, very much. And you know, I think that's answered all of the questions this evening. We are running out of time because I think we've only kept you until 6:45 this evening. If there are any more questions from any of our viewers this evening, please do reach out to myself or to one of my colleagues, and we will get the answers back to you. But I'm sure you'd all join me in thanking Phoebe very much for her presentation. Very insightful, and hopefully a drive for us all to do more to help our planet and the people in it. Thank you, Phoebe, very much.
Thanks
Cheers.
very much, Marcus. Thank you.
Bye.